what is exit strategy and what things contribute to possible exit strategies? So on any real estate investment, the exit strategy pertains to how are you getting out of said real estate investment? I work primarily with rental properties, so let's use rental properties as an example. So if I want to go buy a rental property, there's a lot of things I look at. I run the numbers and I look at the risk. And one of those risk, kind of embedded in the category of risk, but I kind of look at it as a separate topic, is what are the possible exit strategies? So if I buy this property, what's my plan with it down the road? Do I plan to hold it forever? That's an exit strategy that you don't exit. Do I sell it? And if I'm going to sell it, who could I potentially sell it to? Is anyone even going to want to buy it? Or if, whatever the possibility, am I going to refinance it later? Those are the possibilities. Those are possible exit strategies. So, and also make sure you always consider, like, maybe you plan to hold something forever, but let's say life happens and you need to get rid of this property. What are your options going to be? And that really does tie into the risk conversation, because what you don't want to happen is that you end up either stuck with the house itself that you can't maintain, or you can't cover the mortgage, or whatever could happen, or you're forced to sell it way below what you paid for it. A lot of people experienced that in 2008. So these are the things in the risk conversation of what are your potential exit strategies. And this is also kind of part of your business plan of what is my plan for this property. So when you really take some time to look at that, it can change everything, because it's a great consideration. So what things do contribute to those exit strategy possibilities? Well, the big thing really, if you hold it forever, cool, no big deal. Like, that's not really contingent on anything other than you covering the mortgage, or however you're doing it, or you've paid cash at that point, or the mortgage gets paid off, whatever. So one of the bigger thought really is, well, two thoughts. Number one, what if you do plan to refinance? The question about that is the property, and by refinance, I mean like cash out refinance. So cash out refinance, it would have to gain value in order for you to pull that equity out. Like, if you're planning to use equity to buy more properties or to do something with it, you need to make sure you're buying a property that is kind of scheduled to appreciate that much. Or if you're just generally trying to refinance, which this isn't as big a conversation because it's just kind of whatever, is you also need that property to hold value. So if the value on the property declines severely, you're not going to be able to refinance it at the level that you're currently financed on. So that is a consideration. But let's really talk about if you want to sell the property, because this is potentially where a lot of profit can come from in rental property investing. So if you buy a rental property, what's the biggest desire if you sell it? You want to be able to sell it for as much as you can. Well, because again, hello, profit. So if you want to be able to sell it for as much as you possibly can, what are the things that will contribute to that? And therefore, the things you need to look at ahead of time and get a feel for. Obviously, you can't predict every future outcome, but you can look at a lot of things. So I wrote a list because I want to make sure I hit them all. So two things that you always want to consider is what market are you buying in and what neighborhood are you buying in. So let's say you're buying in Atlanta. Atlanta has so much industry, so much diversification, so much growth, population growth. Atlanta, and big industries, like even the movies have moved there. And so it's a good assumption to assume that Atlanta is going to keep growing as a broad metro area. That's what I call market. So I'm buying in the Atlanta market. The Atlanta market itself is incredibly strong. Compare that to, I don't know the current state of Detroit. I haven't looked at it in quite a few years, but way back when, Detroit was a declining market. So the industries moved out, people moved out, population started moving out. That is going to contribute to you selling it, because what's going to happen if everyone moves out of a city? The values are going to get lower and lower and lower. A, who are you going to sell it to? B, what are you going to be able to sell it for? Probably not what you bought it for. versus the contrast in Atlanta, where it's popular, it's desired, people keep moving there at a rapid speed, values will keep going up if that happens, people are going to want to move there. See the difference? It's declining market versus growth market. More specific than that is the neighborhood itself. So let's talk about Atlanta because it is such a booming market. Well, that doesn't mean that every single street and every single neighborhood in Atlanta is going to grow with it. Some streets may get worse by the minute. Some streets may build. You hear the term gentrification. Even some bad streets may end up becoming really nice. So the neighborhood you buy in is going to help dictate your possible exit strategies later. So one of my favorite qualities about a neighborhood or a street, which directly coincides with exit strategy potential, is how many houses on that street or in that neighborhood are owner occupied versus renters. If you have a whole street full of renters, first of all, who's going to want to buy that later? Because one thing you want to think about when you're selling, you're always going to make more money if you sell to a primary home buyer versus another investor. What does every investor want? A discount. Primary home buyers are much more willing to spend, whatever. It's an emotional thing for them. You're going to get more money from a primary home buyer, end of story. If you have a whole street or neighborhood full of renters, are you eliminating the chance of selling to a primary home buyer? Maybe not, but it seems like your chances are going to be a lot lower versus if you have a street or a neighborhood where most of the people there own their own homes, they're long-term residents, homeowners, it has that kind of dynamic. You're more likely going to attract a primary home buyer. Yeah, an investor may come in, but that primary home buyer may be like, I have always wanted to live on that street. So that is one of the biggest things I look for is what's the ratio of owner occupied properties to rental properties. So the last thing I'll say, because that covers most of it in terms of kind of, what I think about in terms of who I'm going to sell, is this is a very general, non-factual statement and one, you can't really measure necessarily, but overall desirability. Like, do people want to move to Atlanta? Do they want to move to Detroit? Do they want to move to Memphis? And, again, not necessarily a factual thing, but when I think about different cities, I have a pretty good, do people move there for fun? Like, people love Atlanta. The intention of this is not to be pitching Atlanta that much, but just use it as an example. People are obsessed with Atlanta now, so people want to go there. What's that going to create? More people coming in, more housing demand. It's going to increase the values. Again, if I buy in Atlanta, do I want to buy on a renter street, a distressed street, or do I want to buy in a primarily home owner occupied neighborhood? For me, I go with owner occupants all the time because aside from the ability to sell to a primary home buyer, which likely would put more money in my pocket, when you have more owner occupants, that actually helps hold the values of properties and increase them more. So looking at that all renter street or neighborhood, the values of those properties are not going to climb as hard or fast as that of the owner occupied. Again, it's about desirability. Where does everyone want to be? They want to be on the nicer street. What's that going to cause? Values to increase. People want to go there. People want to buy there. So always think about your exit strategy before you buy a property. And none of this is to say that you can't be super successful in a declining market, on a bad street, on whatever. But when you look at it from the risk spectrum, you want to think about those things. So if you choose a declining market or a sketchy neighborhood or whatever, what is your exit strategy? Maybe your plan is to hold it forever. In that case, you want to be cognizant of what tenants are going to be available. Like if everyone moves out of a city, who's going to be left to rent the property that you're holding forever? If you want to refinance it, is it going to hold the value in order for you to do that? If you're trying to get equity out of it, is there going to be any equity? And then ultimately, who's going to buy that property? If it's a property full or a neighborhood full of really distressed houses, anyone who might want to live in those houses may not be in a position to buy a house like that or a house period. So, make sure that you understand the whole spectrum of exit strategies and which ones will or should apply to your situation, and gauge that risk, because if it's all risk factors, you know, that could contribute poorly to your investment later. So things to think about.